Hello YouTube, it's Toya Ruth here with the Divas in the Details. You may hear little people in the background because like I said, I'm a mom and this is their space as much as it's mine since I'm filming from my house. So I wanted to pop on here real fast and talk to you guys about mortgage applications, and because there's more than 20 versions of FICO that's out there, which version are mortgage lenders using to figure out whether or not you are a good candidate for them to loan you the money. So every now and then you're gonna see me look over here and over here where I have my notes. When you actually apply for a mortgage, as I found out when I was applying for a mortgage for this particular home in the past, is that they are not using your current FICO score. So if the model at the time is the FICO 8 or the newer version that's out now, FICO 9, that's usually not the FICO version that they're using. The lender relies on what's called the Residential Mortgage Credit Report, and that encompasses 3 different FICO scores from each of the major bureaus. So it is the FICO 2 from Experian, it is the FICO 4 from TransUnion, and is the FICO 5 from Equifax. Since this type of report is going to contain overlapping information, usually the duplicate information is from each report is screened out of the report, and that's why this particular report is called a merge report. So the Residential Mortgage Credit Report looks at 3 scores from each of these 3 major bureaus, and it calculates your highest score, your lowest score, your middle score. Both the highest score and the lowest score are discarded, and it is the middle score from which banks are using to decide your credit worthiness to receive a mortgage for their loan decisions. So for example, if you have scores that are a 680, a 720, and a 740, off the bat, the 680 and the 740 are thrown out, and they're gonna base whether or not you get your loan off of the middle score, which is 720. Also of note, if you have a co-borrower, like a sibling, a parent, or a significant other, the middle score of the lowest applicant is the one that is used. So prior to getting a mortgage, I would say give yourself 6 to 12 months. You should pull your full FICO scores. The best place that I know you can pull your full FICO scores would be from a service that charges. It's called myfico.com. This video is not sponsored. I'm not getting any credit for letting you know about them, but I have found that they have all the versions of FICO that are available. It does cost. So some versions of it cost $29. The most comprehensive one-time snapshot costs $59.95, but it gives you your bank card scores, it gives you your auto scores, and it does give that residential mortgage credit report score. I believe they call it the 245 on their particular report. You can also see different versions of the regular FICO, FICO 8, FICO 9. I'm not sure if FICO 10 is on there because I haven't gone on there lately. However, it is very comprehensive, and I have found that the scores that they give you are true to what is being pulled from lenders. I know when I looked up my scores on their model, US Bank was using the same bank card score when I got my Cash Plus about 6 years ago. So I think that it is a fairly accurate system. Would I prescribe to it on an ongoing basis every month and keep paying for it over and over? No, but when I'm preparing for a big purchase that's so important like this and such a long-term commitment, I would get that FICO score. When you get your FICO score, oftentimes you can figure out, or it will tell you areas that are strengthening your score and areas that are making it weak. You want to use this 6 to 12 month window to keep doing the things that you're doing well and to stop doing the things that you are doing poorly, or wait for some bad things that might be on your report to fall off. Like if you previously had derogatory payment history, like 30-day late, 60 days late, 120-day late, those can be kind of the kiss of death for getting a mortgage, particularly if you were late on a previous mortgage. You want to rethink applying for a mortgage if you had those type of lates or delinquencies, or you would default on something like a student loan. Student loans and mortgages are kind of like red flags if you don't handle those responsibly for getting a new mortgage. Also, you might want to wait for a bankruptcy to be discharged or fall off your report. The cool thing about good things on your report, even if you close a good account, it remains on your report indefinitely. The good thing about bad things that are on your report is that after 7 years, they will fall off. So you kind of get a fresh start every 7 years. I know 7 years seems like a very long time, but at least it doesn't remain on there indefinitely, like good things that strengthen your score remain on there indefinitely. So you want to get your FICO scores. You also want to pull your actual full annual credit report. While your credit report does not give you a score, it does tell you things that are on there that range from areas that you lived previously, your places of employment. I think it even has an area on there for like your phone number. It says every account that they have lenders recognizing you for having been a part of in a lending situation. And you can check your FICO score from myfico.com and your credit report and look for overlap or discrepancies in those reports. If you find something that should not be on your credit report, get it removed before you start applying for a mortgage. You want that to be the most accurate reflection of who you are as a consumer. What else? Oh, even if you're using credit cards responsibly, as I do, where you're not carrying a balance from month to month, you're using it to maximize rewards but not increase your debt, I would not apply for any new credit cards in a 6 to 12 month period. Whenever you open new credit accounts or even personal loans, anything like that, whenever you open new credit accounts, number one, it shows up as an inquiry on your report. And while inquiries only drop your score 1 to 7 points, you don't want to look as if you're actively desperate and seeking credit before you make such a long-term commitment for a mortgage. That's kind of a red flag. Also, you could be in a situation where you're on the borderline for getting a much better interest rate and going to a higher tier of credit worthiness, and so every little point may count for you in a mortgage. Lenders don't like to see, particularly within that last 6 months before you apply for a mortgage, you seeking new credit out. It makes it seem like you're more risky. Now, if you have already applied for credit and looking to get a mortgage early in next year, you can know that when you first see credit, the hard inquiry shows up on your report and it remains on there for 2 years, and then a hard inquiry falls off. However, as far as your score is concerned, it impacts your score a little bit less at 6 months and then has no impact at all at 12 months, even though it's still on there that you applied for something for up to 2 years. So that's a good thing to know. So that's why I say kind of that 6 to 12 month window is when you don't want to apply for new credit. Then we talked about, the best place to pull your mortgage credit report scores, your FICO scores would be from myfico.com. The reason why I said that is because as a benefit of having a credit card for membership, oftentimes your credit card company will give you a free score. I have found quite frequently that when you get a free score from Experian or when you get a free score from Equifax or from TransUnion, it tends to be a Vantage 3.0 score. That is a very anecdotal score that you really should be looking at to look at why you got the score that you got instead of the actual numbers, because it looks at behaviors. It looks at how long you've had credit, so the average age of your account. You want that to be at least 7 years and more approaching 9 to 10 years, the longer the better, to maximize your Vantage score. You also don't want to have very many hard inquiries in a short period of time. Under 3 inquiries, 1 to 2 inquiries every 12 months is ideal. You also want to have an excellent payment history, so no more than 1 late payment out of all your accounts. I would really try to never miss a payment ever, because even that will kind of tank your score because of the way the model is weighted. So basically, a Vantage score will teach you, I need to model better behaviors. I know what I'm doing well, know what I'm doing poorly. But if you want the score that the lenders are using, you will likely have to pay for that score, particularly because if you have someone like, I believe American Express does give you your Experian score for free, it is a FICO 8 score. So it's still not the score that they're using for a mortgage. So you will likely have to pay for a mortgage score. I hope this kind of clears up some things. I get a couple of questions every now and then that I have to let me go behind closed doors and try to recall what my experiences were, pull my paperwork and see what they reported my scores were and where it came from, as well as do a little bit of research. But hey, that's why we're all here, to learn and grow together so that we all win. So I hope you found this helpful about why there are so many different FICO scores, because different lenders are looking for different behavior patterns when they're choosing to give you something, as far as banks for credit cards, as far as auto lenders, and then particularly for mortgage. Also, you'll find that mortgage lenders are much more scrutinizing and much more detailed than lenders who just want a quick snapshot of what you've been doing, because they're not locking you into such a long-term commitment and they're not giving such a huge volume of money. So if you found this helpful, thanks so much for watching. Please comment, like, and subscribe. See you next time with the Divas in the Details. Bye-bye.